Hey everybody. Yesterday we had a chance to talk to Brad Hargreaves, the founder of Common. Now, in this podcast, you're going to learn why Common went bankrupt and also why the business model was actually not profitable and what could have been changed. We at Art of Co truly believe that co-living can be profitable and can be a force for good for residents. So feel free to check out other resources at Art of Co in terms of how to launch and operate your co-living business. Now, let's listen to Brad himself and see what he has to say. Enjoy this podcast, and if you want more like this, or if you have any of the key learnings that you want to share, please put them in the comments. We'd love to know.
Hey, Brad.
Hey, how's it going?
First of all, thanks for coming on.
Of course, thanks for having me.
Yeah, and thanks so much for all of the work and the effort you've been putting into the co-living scene in the last almost decade now.
Yeah, of course, it's been a labor of love.
Yeah. Okay. I mean, when I saw the news last week, I was like, wow. Common bankruptcy. Got a lot of messages. Everybody's asking what the hell happened. And to be honest, I had no clue. I had a few assumptions. People started making out some assumptions on LinkedIn, and then I was like, "Look, let's not make assumptions. Let's talk to the person that maybe knows the most about this, which is the person that actually founded this." Now, you've been at Common until 2022, right? Then Common has been taken over by Habit. So, as you said in your email, I think it would make sense if we start at the beginning and we define what Common was. So maybe walk us through. What was Common in terms of a product? Where was it when you left it, and what happened until then?
Yeah, absolutely, and I'm happy to walk through the story and dispel any misconceptions. I'll try to avoid getting too technical on the real estate finance side. Please stop me if I do and need to explain any terms. But a big part of this and understanding why it happened requires understanding how housing gets financed and built. Particularly in the United States. And I'm going to highlight some of the differences between how it works in the United States from how it works in Europe to show why some of the European concepts have had a very different trajectory than the American co-living scene, where pretty much everyone has gone under. So Common started in 2015 really to address a housing affordability issue. Prior to starting Common, I had started General Assembly, which built and became the largest technology and design trade school in the United States. We had about 30,000 students a year coming through our doors, and many of them needed a place to live. And not just our students, but our instructors and our employees. When you looked at how they found housing in these expensive urban hubs, places like New York, DC, San Francisco, Los Angeles, they would look for a room, not for an apartment. And that took them onto Craigslist and all manner of roommate matching sites. And they would find their way into these apartments, which were not designed for roommates in any way, shape, or form. So we said, hey, there's an opportunity to create a higher quality and more affordable type of housing by building apartments designed with roommates in mind. That's what Common was. We were building primarily 3, 4, and 5 bedroom apartment units, working with developers, and just maybe take a minute on how we fit into the ecosystem. We were not a developer. We did 2 things. We were a property management company, and we were a designer, and we got paid for both those things. As a property manager, we got paid anywhere from 3.5% to 10% of a building's revenue, depending on the size of the building. Smaller buildings, higher percentage, bigger buildings, smaller percentage. We also got paid design fees. So when a developer came to us and said, hey, I like this co-living thing, help us design it, we had a lot of really unique data and insights into how to design co-living apartments well. That was the initial conception and model. We did in the early years sign some master leases just to prove the concept out. That was a pretty small part of the overall Common story. And pretty quickly by 2017, we were almost entirely management agreements. One thing that is important to understand as well is we would adapt the model to different layouts, different typologies, depending on where we were. So we would go to Seattle, for instance. They allowed really small micro apartments in Seattle, and we ended up being a micro apartment manager. As a property manager, we didn't have total control over how the properties were laid out. So we had our opinion, but ultimately it's the real estate developer who decides, here's what the layout is, here's what the aesthetic is. We have a binary decision of, do we manage it or do we not manage it? So that's really have the key thing to understand in terms of how we fit into the ecosystem. One big thing changed in 2020, the COVID pandemic. And what that accelerated for Common was a move to diversify the types of properties we were managing. So we started this in 2019, taking over more traditional residential buildings. We launched the NOAA brand, which was our workforce housing brand. And these were just taking over normal residential multifamily, is what you call in the US. In the UK, you call it build to rent. Just taking over normal buildings and managing them for a fee. And we had some pretty cool technology, and we had a more centralized management structure, which added some efficiencies. But it wasn't nearly as big of a change as we are managing these co-living apartments. So why did we do that?
And just to understand, when you say like we took over normal buildings, what type of buildings are you referring to compared to before? Before there was mainly 3 to 5 rooms per apartment, and now it was...
Yeah, so when I say normal buildings, what I really mean is studios, 1s and 2s. So studio apartments, 1 bedroom, 2 bedroom, just like any normal multifamily building in the United States. Once again, trying to translate this to an audience outside the US, most apartment buildings that are built in the US are built to rent. It's not like you go to Canada or you go to the UK, where most residential buildings are built as condos and then sold to retail investors. Condos exist in certain parts of the US, like they obviously are built, but they're relatively rare in compared to build to rent housing. The US has about 45 million units of rental apartment housing. So it's a huge market. So we started managing just typical rental apartment buildings. The reason we did this is to get density in the cities in which we operated. As a co-living designer and manager, we had expanded to about 15 cities open and another 20 odd cities with development projects in the pipeline. That was a really tough position to be in, because in most of those cities, we had 1, 2, 3 projects. That wasn't enough to sustain a property management team on the ground. So big question is, how do we get more density in that city? Even if the projects that we are managing, we could, afford, a maintenance technician, a leasing agent, a community manager, we're very limited in, okay, one of those people takes some time off, one of those people calls in sick. We don't have another person necessarily in that market. So what you really need is 2 of each of those people. So you need 6 people in every market. So it became very difficult in those new cities where we had opened up and we're still subscale to get the kind of density we needed relying on co-living alone. Remember, we are, our conception of co-living is very much new types of units, 3, 4, 5 bedroom apartments. Well, those have to be built from scratch. You can't renovate an existing building into a 3 or 4 bedroom apartment. It just doesn't work. Like, that's what Quarters tried when they expanded to the US, and it didn't work from a product perspective, and it did not work from a financial perspective. So building ground up is what you have to do. That is very difficult to do in many cities simultaneously. So we tried to supplement what we were doing on the co-living side with more units from outside of co-living. That ultimately turned us really into another residential property manager. That was successful, by the way. We got a lot of new units onto the platform. But by that point, we had 6,000 units under management. And, we weren't as clear of a co-living identity as I think we were, one, as our brand was known for, and two, certainly not as we started the business. So we saved the company through the COVID pandemic, but I lost a little bit of our identity in that process as well, too.
Right now we're at so you said 6,000 units. We're in 2022-ish, right?
Yeah.
What has been your relationship then since 2022 until today with Common, and what do you know? What can you share? Do you think happened until today?
Yeah, totally. So we a couple of things. One is summer of 2022, we hired a CEO, brought in Carleen Holloman, incredibly talented woman who had 3 decades of experience in the hospitality management industry. At that point, Common, I looked at it, our investors looked at it as this is a residential property management company. I had been running it for 7 years and didn't want to run it anymore. It's important element to that as well. So needed a CEO with residential property management and with overall property management client service experience. So one of the challenges of running a property management company is you are serving real estate owners. You are a services provider. You are not first and foremost a brand. You are not first and foremost a technology company. You are a services company. And you need someone who every week is going to get on a plane, visit the sites, talk to the owners, pitch new owners. And so that is who we brought in. Arlene, I think she did a fantastic job. But around that same time, interest rates started going up, which made new development projects really tough. And that ultimately, more than the pandemic, is in my view what did Common in. Because remember, I talked about those 2 revenue streams earlier, property management and design services.
Yeah.
Property management, I don't think was ever profitable. Maybe in certain cities where like New York and LA where we had scale, it was profitable, but overall it was certainly not. We certainly did not generate a profit from it. And you talk to people in the rental industry in the US, and that is, none of them say like, wow, my property management business is so lucrative. They do it for other reasons. They do it because they want to maintain their properties in a good way. They do it because they like the data it provides. But nobody says like property management's a great business. And so starting in really 2023, that other line of business, the design services, which were profitable, they went away. And so one last thing I want to say is I think the European co-living companies have had a very different trajectory than the US co-living companies. And I want to explain why that is. So when we first started talking to Habit, we were shocked by how profitable their master leases were. And I think in a European context, a master lease is great for an owner. Like, owners want master leases because they like the certainty that a corporate guarantee provides. Even on a residential building, on a rental apartment building, an owner would on average take a discount to what they would receive otherwise if they had to lease up and tenant the building themselves. So as a company, you can take advantage of that difference between what a potential tenant is willing to provide, a corporate tenant is willing to provide, and what you would be able to get otherwise. So that drives a lot of profit margin. In the US, it's the opposite. In the US, if you are an owner of a residential building, of a multifamily, of an apartment building, you would much rather tenant it up yourself and have a roster of paying tenants directly on the lease with you than you would lease it to a corporate tenant. And the reason has to do with the differences in the lending ecosystem between the US and Europe. In the US, you have Fannie and Freddie. You have the GSEs. And what they do is they give the cheapest debt you could possibly get on buildings, but your building kind of has to lease up and look in a certain way. And if you have a roster of tenants on your lease and everything looks normal, you can get Fannie and Freddie debt. And banks are going to say, hey, this looks like a normal residential building. We know what this looks like. It's going to have the lowest, it's going to trade for the lowest cap rate. It is going to get the cheapest debt possible. And that's what owners want. In Europe, the rental ecosystem is not nearly as, the capital markets aren't nearly as evolved. You don't have Fannie and Freddie. You know, student housing trades at a lower cap rate than rental apartments. It's flipped in the US. It's funny. But like the capital markets is totally different in the way it treats rental housing. So you're able to take advantage of that as a European operator, do master leases, and earn a really good margin on those. Everyone who's tried to do that in the US has gotten wiped out, from the short-term rental operators to the co-living operators to even a lot on the, on the office side too, although that's not what I'm talking about with respect to capital markets. Master leases just are not as, certainly in residential, are looked down upon in the US.
Very interesting. But so would you then say that, so it seems like your model was, you had on one side service management, and here you had like 3 to 10% margins from overall revenue or rent, right? That would go to your company, but that didn't make any real margins to Common. The real margin the delta came from your design services that you were offering. And so you were, how to say it, you were required to grow, right, and to open up new properties in order for that margin to continue flowing in. And once COVID hit, you stopped growing, you stopped expanding, and so just maintaining the apartments itself didn't help to continue.
I would push back on one part of that, which is the thing that slowed the growth and made people hesitant to build co-living buildings was not COVID, it was interest rates. People were still doing co-living after COVID. I mean, there was probably a pause from, I would say, obviously March of 2020 to spring of 21, where a lot of projects got, put on pause for a while. But it did come back in a big way. It was more of just where rates are has made all ground up development challenging.
And so let's say, so to me, now my question is like, as a US operator, as a US asset light operator, do you believe that there's a way to be profitable? And if yes, how?
A US asset light operator, not very profitable, I would say. Could you be profitable by sticking to one market, being very selective about who your clients are? I mean, that was another problem for us as well. Just because we wanted to grow and we wanted to dominate the co-living management market in the US, we probably weren't as selective as we should have been about our clients. Now, I don't think this would have changed the outcome, but if I think about what I would have done differently just from a moral standpoint, running Common, I think Common would still be bankrupt today if I had done this differently, but it may have been bankrupt sooner, in fact. But being a property management company, where like you have a mandate to dominate the market, and someone decides they're building co-living and is choosing managers, you don't want that to go to a competitor. So, some of our owners were some of the worst people on earth, and having to work with them and having to ask our employees to work with them, I regret that.
And would they...
Not all of them, by the way. We have some great owners too, so I don't want to, speak poorly about all of our owners, but there's few of them that were real pieces of shit.
Yeah, I understand. And do you think there could be like anything else that could be done differently? So, for example, what I'm seeing is like a lot of like co-living founders, they don't always have to do good ratios. So, for example, like overstaffing, right? Like one thing that in Europe works pretty well is having, for example, like one person for like 40 to 50 tenants. That's kind of like a ratio that seems to work better. Okay. I'm wondering, could there have been like certain things that could have been changed? For example, increasing the prices a bit, or adding up short stay to long stay. Like, could there have been ways for you to make like the main business actually profitable?
So I don't think there was anything in terms of pricing or staffing at a macro level that would have changed the outcome. I mean, I think we were pretty good at that, and we looked hard at kind of what are other operators doing, and I don't think we left money on the table on a rent pricing side. Could mixing short term in have helped? Absolutely, but for short term, I do believe you need private units. And remember, what we were managing was mostly shared apartments.
Yeah.
I think shared apartments does not mix well with short term stay. I think if we had a bunch of micros or a bunch of studios, layering in short term would have been more viable, and that would have helped a lot. We were generating a premium above market. So if market rate NOI was $2, we were generating $2.50. We weren't really able to capture much of that premium, because if we tried to go the master lease route, owners demanded a premium in the US for that master lease, which ate up a lot of that margin. And on the management route, very, very tough to push those percentages. We found it really hard to go from asking for 4% to asking for 6%. And everything's based on gross rents. So it's very, very tough to take a bigger chunk of that. So we weren't really able to translate as a management company the premium we were generating to any benefit to us as an operating company. So we're just a subscale property manager at the end of the day.
Yeah. So with that in mind, like, how do you see like the future of co-living in the US specifically?
Well, I think small local operators will continue to exist. I mean, small local operators existed before common, people taking a handful of units, a handful of homes, renting them out by the bedroom. That will still exist. I do see short-term rental and more hospitality-like offerings that could be interesting if you're renting by the night. There is a real premium to that, and you can, in that model, generate higher management fees that can make the business make sense. So I do believe there are paths to that. The model of like large-scale co-living as a housing affordability play, I don't believe there is an asset-light approach that makes sense there. I think there's a reason why between Ollie, Star City, quarters in the US, us, none of the players have succeeded. I think there's a reason for that. Are there opportunities for developers to layer in co-living? Absolutely. I think they probably have to self-manage to do that right, because there are not a lot of third-party managers out there that can do it well.
Got it. And so what's next for you? I'm really curious.
Well, I write Thesis Driven, which is a Substack I launched in late 2022. We cover all sorts of real estate investment themes, future of real estate. We also teach courses about real estate development, focused on prop tech employees and people who want to understand the real estate industry better. How real estate finance works, how real estate development works. A lot of the topics I'm talking about here around debt, leverage, equity, all these things are some of what we cover. So enjoying not getting on planes as much anymore.
Sweet. And to all of the co-living entrepreneurs out there, because like there's more and more people that want to create co-living that have been inspired also like by you and by so many others. What would be like some other pieces of advice that you'd like to give?
Well, I mean, a lot of the people who are building co-living businesses, I've just, tremendous respect for. They're going at it in a much smaller scale, much more geographically focused way. Someone building a, mixed term stay, single building, focused on a single city, destination location. I mean, that stuff, like, that's great. And I think those people can and will be very successful. I think the folks that are looking to scale it up, just be very careful with what costs are truly at headquarters and what costs actually are operating costs. Because when you hit a day where you need to cut back on headquarters, how many of those headquarters expenses are actually needed to run the business? When I see more scaled co-living operations, they almost always get this wrong. And we tried to not get it wrong at Common, and we still got it wrong in a lot of ways. And it's a very tough thing to get right. So, but if you're keeping it small scale, you're keeping headcount low, you're focused on one or two geographies, I think it can be a very successful business model.
Amazing. Thank you so much.
Of course. Thanks for having me on.
I do have a little gift for you. I don't know if it's a gift, but it's a surprise. Do you know an app called Suno?
Suno?
Yes.
I don't think I do, no.
All right. It's an AI that basically writes songs. And we asked it to write a song about Common based on an article about Common's bankruptcy. And
Oh, no.
I just want to show you the first minute. Are you down?
Oh, yeah. Up.
All right. Let's go.
Come hit the headlines, bankruptcy blues. But why did it happen? Let's break down the article news. Funding pressures high. These two stand. Acquisitions and expansions, cities far and wide, operations stretched thin, hard to stabilize. All-inclusive dreams with overheads high. With resilience in the face of it, reach for the sky. Industry-wide change, it's a collective dream. Collaboration, cooperation, starting from multi-generational homes, global scenes. We shape the future, living out our means. Here's CEO Brad Hargreaves, the store folds with the article, lessons in the lows, wisdom untold. Ask your questions, join the conversation. Together we build a resilient foundation. Resilience, innovation, the keys to thrive in the Coliving movement. We come alive from struggle, pave the way. In our global article community, we find the way.
Amazing.
That was it, my friend. Thank you so much.
Wow. Is the app called Suno?
The app is called Suno, yes.
So glad I know about that. I'll check it out. Make some songs.
Amazing. Well, thanks so much. Any final words?
No, I'm glad to be able to come on and tell the story.
Thank you. Brad, again, thanks for pioneering. And I really highly recommend everybody check out Thesis Driven, subscribe. And also, because I've seen it's not only you, now you have like also a team that you got on and guest writers, I think. So really curious what's going to come out of this.
Thanks so much.
Thank you.